One of the big themes in the market at the moment, and possibly one of the more overarching issues in the markets, is just what's happening with the dollar. We've had a lot from the Federal Reserve about taper talk. That has given some recent direction on the upside, but broadly speaking, it's been a period where we've seen a lot of pressure brought to bear upon the dollar. Let's get some more now from a technical point of view with Ron William from RW Advisory and take a look into the future possibly as to see where things may go. Ron, it's good to catch up with you again. We've spoken to you before about this subject and about some other subjects that sort of hang around this area, such as gold. I know we're going to talk about in just a minute time. But let's look first of all at what's happening with the dollar. The title here is USD pending collapse, but there's a big question mark at the end of it. Let me ask you first of all what your thoughts are about the US currency.
Verging on an important breakdown level, whichever way we look at it. So the dollar index or the Dixie, as a case in point, at a key strategic level of 89.90, and we're seeing that kind of bear trend in the dollar year to date, and actually from the pandemic peak highs of last March, down 13%. So the trend is down, and we actually failed to bounce back earlier on this year between Jan and March. And there's also signs of capitulation as well from bulls to bears. So for now, down. We do need to break below those key levels in order to suggest a collapse ahead. But certainly the long-term view is for that breakdown risk.
Okay. The way to trade this, of course, is by using one of the largest component parts about the dollar basket, and that is about the euro dollar. Just talk us through the euro dollar chart now, because I know this is more relatable, I think, isn't it, for some traders?
Yes, so euro dollar is basically the mirror image of the dollar index. So for trade centric ideas, euros is the lion's share of the dollar index weighting, more than 50%. And if we're looking at the chart, it's been sideways year to date. There has been a weak bounce back. My view is it will likely fail at the prior peak levels of 123.30 and change. And if we do get a failure, then do look for a resumption down below 117, and then so back down through 120 and 117, and that would complete a sizable top on euro dollar.
Now, I know that when looking at this, you can look at a number of different sorts of metrics. Going on to your first chart that you provided, which gives us some potential insight, just wanted to ask you to talk through some key measurements for the dollar.
Yes, so the jury's out as to whether we get the major currencies outperforming sizably against the dollar. What is key is that the dollar side of the equation is weak and will continue to be so. And so looking at the dollar across a basket of different currencies, so if we just look at the broad measure, dollar index, number one, number two, the actual Federal Reserve weighting for the dollar, and then last, number three, an emerging market basket of currencies against the dollar, the inversion of that. All three charts show a bearish setup confluence and verging on breakdown levels. So that's the first point, and that really is the bearish setup of a pending collapse question mark. What's interesting is the liquidity sentiment measures also showing not just price, but liquidity capitulation from bull to bear year to date. So that Jan to March failed rally is actually coming through on the short side right now.
If we move on to take a look in some more detail about what you were just referring to on those live charts, and if we look at your multi-year double top pattern, I think this gives a better idea, doesn't it, as to how people should play where we are at the moment on this foreign exchange market.
Yes, well, going back to just the first principles of technical analysis, trend and pattern, the trend has been in a reversal mode for some years now, a multi-year double top reversal pattern, a distribution of sorts. The educational takeaway here is the bigger the top, the lower the drop. And that's if and once we get the break below 89.90, then that drop will be a reality, and the collapse hypothesis that I'm posing here for traders and investors. There is a short-term kind of scenario where we get ongoing volatility up and down in the dollar, particularly as we move forward in this new month of June, July, where I'm expecting negative seasonality, i.e. A spike in volatility, rotation out of the risk markets such as the stock market, and that could make a bid for the dollar and give some support. The maximum risk level on the dollar index bear scenario is at 94. We are allowed a 5% deviation up from current levels in what could be a safe haven push back into the dollar in coming weeks and months if we get an increase in vol. Anything above 94 would put this long-term bear view on hold and maybe require some reassessment, but only a short-term scenario, and at very best it may actually produce further short opportunities for the dollar long on other currencies versus the dollar.
Yeah, let me just quickly ask if we can go back to the chart on this, because I think it's important to monitor the levels you've been talking about, with that chance that we could well see some sort of capitulation, and we could well see that the dollar rise. You've got that dotted line there above current price action on this particular chart. Down below where we are, you've got that dotted line, which is obviously of critical importance, because if you see a drop below the 89.90, get a candle close below there, you're then on that double top sort of pattern. Just talk to me about that second lower line that you've got in the dotted line at the bottom there, just below the 82,500 level. Talk to me about the effects of a potential candle close below that.
Yes, so if we basically break that first box range, which is essentially the double top multi-year reversal pattern, that then as a maximum projection extends into that collapse scenario. I tend to be more conservative with targets, just to take profits at strategic levels into the bigger target, as opposed to aiming too high or low in this case. So for the dollar, a conservative target down, if we break below 89.90, would be around the 86 level, and that represents the 66% two-third retracement of the entire dollar bull market since 2008. So well over 10 years of uptrend history. That would be a structural damage for the bull market, and a potential downside target as and when we potentially hit that.
Now, I know that having spoken to you before, you like cycles. Looking at historical cycles, what do we know from what's happened as to potentially what could evolve for the dollar from here?
Yeah, so cycles are essential both in life and markets, particularly from the timing point of view. And in markets, they give us a sense of structure and rhythm. And what we can see here is the dollar exhibits long cycles, traditionally averaging out 15 years or so. We're at the tail end of the news cycle, or bull cycle, I should say, where asymmetric downside risk is greatest. That is over the next few years, as part of a disruptive environment, according to my cycle work, just across global cross-asset markets. The chart that we have there on the screen is showing the dollar index going back to the 70s. So it's a whole lot of historical data there. You do need to go as far as possible in order to visualize the historical context of these cycles. So long cycles on the dollar, we're at the tail end of the new long cycle, which highlights asymmetric risk over the next few years. And just one caveat here, the dollar will likely be the safe haven currency for a while longer, but that will fade over time as the crisis extends and ultimately matures, then there will need to be alternative safe haven plays out of fiat currency into hard assets. And this is the real point here behind this discussion that we're having. What next? If the dollar does lose its crown this year and next, where else should investors and traders move?
Well, let's pick up on that point, because that is clearly the obvious question. I mean, it is possible, obviously, to short the dollar, so you can benefit if you do believe this case that you're displaying today. If you do believe that, you just short the dollar. But safe havens, talk to us a bit more about safe havens.
Yes, so there's a range that we can pick. I mean, those who want to trade, of course, they can short or long, short the dollar and long anything else against the dollar, and play the relative beauty game. In that regard, in terms of safe haven, of course, cash is what is traditional for portfolio managers. But for those who want to have a little bit of yield and return and capital preservation, ultimately, the analog and digital gold, otherwise known as gold and Bitcoin, these are the two assets that are held in safe haven regard. Looking purely at gold, this is building on a discussion that we had just recently. Gold's trend is still your friend. We're asking the open question last time we looked at the chart, and now it's clearly confirmed that resumption of the uptrend. And so the chart there shows the how gold has been holding above its 200-day line, and that's is continuing higher. I think it was at 1890. That was the key trigger level for the gold market, and now suggesting that we could move back to 2000 glass ceiling and 2400 with a spike risk to 3000. So we've got the long-term chart there on the left, and the top right chart insert showing the how it behaves with the 200-day line. Gold should also outperform commodities. That's the top left-hand insert, just showing that it's gold relative to commodities, but also gold overall as an inflation and risk hedge. And just a final word, the bottom right-hand chart shows that money flow has been going back into gold out of digital assets, Bitcoin in particular, after the recent crash that we saw in last few weeks, 40% down in just 1 week. And moving on to the second alternative safe haven, Bitcoin, we can see the recent crash in context. Certainly a big move down, 40% in just 1 week, and a catching falling knife situation. The peak was actually captured through the trend analysis. You can see there a tripling of regression overlay that was drawn before, and also coinciding with a momentum exhaustion signal, the DeMark signal, the red 13 at the top, and some of the timing filters before and after the peak out. What's interesting is we look at the right-hand side of the chart. This is showing how digital assets, and Bitcoin in particular, is likely to have, yes, further short-term downside risk, but long-term buying opportunities ahead in the second half of this year. Top right-hand chart shows that historically it is very oversold and due a recovery from those extreme multi-year levels. Second middle chart shows a cycle projection suggesting a potential bottoming process from July onwards into the second half of this year. And then last but not least, a very long-term percentage chart of Bitcoin, just showing that into the new halving cycle that we're in, there's still further upside ahead. Best case and even conservative case are very bullish.
Look, Ron, we'll have to leave it there, but thank you indeed for joining us with this look at the US dollar and the potential outcome of where we are at the moment in the market and some of the safe havens to watch out for. For more videos like these, follow us on Twitter and Instagram and subscribe to our YouTube channel.